Every single cycle there comes a moment where retail panic collides with institutional strategy. And right now that moment is staring us right in the face. While the average investor is dumping positions out of fear, the bullish dynamic is unfolding today across equities, Bitcoin, and yes, even XRP. This is not financial advice. Look at what's happening. Retail investors just unloaded nearly $1 billion in stocks and crypto in back-to-back weekly sales. That's after almost 9 months of consistent buying. And what happened the very same week? Institutions bought $1.1 billion worth, their longest consecutive streak of accumulation since the 2022 bear market. Think about that. While everyday investors are taking chips off the table after a small rally, smart money is quietly positioning themselves for what comes next? A flood of new liquidity. And this is where most people miss it. Because they're not studying M2 money supply. They're not looking at liquidity cycles. They're not paying attention to the Fed's roadmap. Instead, they're reacting emotionally, taking profits way too early, just like we've seen countless times before. But the money supply has already been pushed forward 18 months. Rate cuts are coming. Liquidity is on the way, and the institutions know it. They're stepping in ahead of time while retail gets left behind. Now, before we go further, let me quickly say this. If you want to position yourself the way institutions do, you need the right tools and knowledge in your hands. That's why I put together the Ultimate Millionaire Investor Guide, Find 100X Stocks. It's packed with documents, images, videos, and more, breaking down exactly how to identify asymmetric opportunities before the crowd. I've pinned it in the comment section below this video. Check it out and don't miss it. Back to the data. When you zoom out and really look at this from a macro perspective, it becomes crystal clear why selling now is the single biggest mistake most people could make. Because every single time the Fed has pivoted in the past, cutting rates, easing monetary policy, the result has been explosive upside. Just go back to November when the Fed first moved. Markets rallied hard, pushing into new highs by January. That wasn't an accident. That was liquidity at work, and it's happening again. So ask yourself, do you want to be on the side of fear-driven retail traders, or do you want to be on the side of billion-dollar institutions loading up while everything is still cheap? Because the choice you make right now could define your returns for years to come. Cathie Wood has been one of the loudest voices highlighting this exact setup. She's calling Bitcoin a once-in-a-generation scarcity asset, a hedge, a new technology, a brand new asset class unlike anything before. She's not talking about Bitcoin going back to $30,000 or $40,000. She's projecting $1.5 million over the next 5 years. And she lays out 3 drivers: substitution for gold, institutional adoption, and the demand coming from emerging markets where citizens desperately need protection against wealth confiscation and inflation. And she's not alone. Look at the behavior of big funds, pensions, and asset managers. For decades, they ignored Bitcoin, treating it like a fringe idea. But now it's becoming impossible to ignore. ETFs are live. Custody solutions are maturing. Compliance rails are being built. The same infrastructure that allowed gold to go mainstream is now being applied to Bitcoin and crypto. Once institutions really open the floodgates, supply-demand dynamics will get wild. Because unlike fiat currencies, there are hard caps on issuance. Take Bitcoin supply, 21 million units, maximum. We're already at nearly 20 million mined. That scarcity alone, in an era where everything else is being debased, is a magnet for capital. Add in the fact that AI and automation are reducing scarcity in other parts of the economy, like labor, and it becomes obvious why markets will chase the few assets that still have it. Bitcoin stands at the very top of that list. But here's the part most people don't fully grasp. Bitcoin is not just digital gold. It's both a risk-off and risk-on asset. It moves during times of fear, just like gold, but it also rallies with tech. because it's part of a brand new monetary system. That duality gives it an entirely different edge compared to anything else in markets today. During the Greek crisis in 2015, when fears of an EU exit were rampant, Bitcoin surged every time headlines spiked. Fast forward to the US regional banking crisis, it played the same role, again, offering safety when trust in traditional institutions faltered. At the same time, it acts like a tech play, benefiting from growth cycles, innovation, and capital inflows into digital assets. That's why Wood calls it a big idea. It's why institutions are circling, and it's why retail panic selling right now is handing them exactly what they want: cheap supply. Meanwhile, let's not forget what's happening in other corners of the market. Oil prices dropping as sharply as they have represents one of the biggest stealth tax cuts for consumers we've seen in years. Lower energy costs ripple through the entire economy, cushioning inflationary pressures and setting the stage for a much more favorable backdrop for risk assets. It's something very few people are paying attention to, but it matters massively. The US dollar, too, is at the center of this. Yes, it's been weaker in recent weeks, but zoom out and it's still holding strong historically. If deregulation, tax cuts, and tariff reductions materialize, the return on capital in the US relative to the rest of the world shoots higher. And that's dollar positive. Remember the Reagan years? The dollar became so strong back then, the world had to coordinate just to bring it down through the Plaza Accord. That wasn't weakness, that was dominance. And we could very well be setting up for another cycle like that. And here's the kicker. The Fed is boxed in. They've already shrunk money supply more aggressively than we've ever seen. But as growth slows, pressure builds, and the political cycle heats up, rate cuts become inevitable. That means liquidity injections are right around the corner. Liquidity is fuel. And every single major move higher in markets over the past century has been powered by exactly that. So when you look at retail, dumping their holdings after a small bounce, and institutions scooping it all up, you can see the game being played right in front of you. It's the same game that's been played over and over. The only question is, which side of it are you going to be on? And that brings us back to the point. Bitcoin, XRP, gold, and even equities are standing at the edge of a liquidity surge. The signals are flashing, the institutions are moving, and retail once again is on the wrong side of history. When you strip away the noise, what we're seeing today is a perfect storm of catalysts that could redefine the trajectory of not just Bitcoin, but the entire crypto and equity complex. Because make no mistake, these markets are more intertwined than ever before. The same liquidity that lifts the S&P 500 is the liquidity that fuels Bitcoin's next leg higher. And the same institutional capital that used to sit on the sidelines is now beginning to spill over into digital assets at scale. The difference this time is structural. In prior cycles, Bitcoin moved largely on speculation. Small retail traders, pockets of high net worth individuals, and a few adventurous funds were the ones driving volatility. But today, you've got publicly traded companies with Bitcoin on their balance sheets. You've got ETFs approved and trading on major exchanges. You've got sovereign wealth funds exploring allocations. That's not speculation. That's systemic integration. This integration is why institutional buying is so powerful right now, because they're not treating Bitcoin as a gamble. They are treating it as a necessary hedge, a portfolio diversifier, and in some cases, a core holding. That mindset is entirely different from the early days. And when institutions commit, they don't play small. They don't dollar cost average a few $100s at a time. They move with billions. Now think about this. Bitcoin's supply, issuance, is on a mathematically declining schedule. Herrings cut the flow every 4 years, reducing new supply just as adoption grows. The next H, halving, is not years away anymore. It's right around the corner. Every cycle before has shown the same pattern. Supply squeeze plus demand surge equals massive repricing. And this time with institutional involvement at a level we've never seen before, the magnitude of that repricing could dwarf all previous cycles. But let's broaden the lens beyond Bitcoin for a moment, because what's happening with XRP, Ethereum, and other top-tier assets is just as significant. XRP's unique role as a bridge currency for cross-border payments positions it in a completely different category than Bitcoin. While Bitcoin is global digital gold, XRP is infrastructure, a tool designed for speed, liquidity, and settlement. If banks, payment providers, and financial institutions continue to adopt XRP, its price action won't just be speculation. It will be usage-driven, real-world flows powering valuation. Ethereum, on the other hand, has become the backbone of decentralized finance. Billions of dollars are locked in Sylph protocols. Applications are scaling, and Layer 2 solutions are driving fees down, while capacity grows. Every sign points to a maturing ecosystem. And again, this time, institutions are watching closely. They see Ethereum not just as a currency, but as a digital economy, a network, generating cash flows, fees, and value. That's why we're seeing asset managers launch ETH products, why developers are flooding into the ecosystem, and why, despite volatility, the base case for Ethereum remains incredibly strong. What does all of this have in common? Scarcity and adoption. Bitcoin has scarcity hardwired. Ethereum has utility and network effects. XRP has institutional alignment. Together, they represent a new frontier of assets that don't rely on traditional earnings or dividends, but instead on technology, usage, and global demand. And that's why rate cuts, liquidity, and monetary policy are so critical here. Because when the cost of capital drops, risk assets thrive, stocks rally, cryptocurrencies soar, gold catches a bid. And it's all tied back to the simple fact that money has to go somewhere. Institutions sitting on trillions of dollars are not content leaving it in cash, earning nothing. They are forced by design to chase returns. And in a world where growth is slowing, debt is mounting, and fiat currencies are being diluted, the assets with scarcity and adoption shine brightest. Now let's dive into the psychology of retail versus institutional flows, because this explains so much of the current divergence. Retail operates on emotion. They buy when charts look good, headlines are bullish, and their friends are bragging about gains. They sell when markets pull back, when fear dominates, when uncertainty creeps in. It's reactive, it's short-term, it's survival-based. Institutions, by contrast, operate on positioning. They accumulate during fear. They lean into liquidity cycles, and they diversify into assets that give them asymmetric upside. Their time horizons are measured in years, not weeks. They don't care about day-to-day volatility. They care about capturing the macro move. That's exactly what we're seeing right now. Retail panic selling after a small rally. Institutions buying relentlessly. 6th consecutive week, longest streak since the last bear market. The question isn't why retail is selling. It's why they always sell at the wrong time. And the answer lies in not understanding cycles. Money supply expansions lead markets higher every single time. The lag is predictable. The flow is undeniable. And yet retail misses it over and over again. So what happens next? Liquidity injections come through rate cuts. Markets begin pricing in the pivot, and asset prices climb. As that climb accelerates, retail investors who sold early are forced to chase back in at higher levels. That buying fuels even more upside, while institutions who position early ride the wave with minimal stress. It's the same script we've seen play out for decades, across asset classes, across cycles, across geographies. Now, let's tie this back to macro developments, because beyond monetary policy, we're also seeing geopolitical shifts that make crypto even more relevant. When capital controls tighten, when inflation eats away at purchasing power, when governments abuse monetary levers, citizens and businesses look for alternatives. Bitcoin is that alternative. XRP can be that alternative in payments. Ethereum can be that alternative in digital infrastructure. This is not a local story. It's global. Look at emerging markets. In places where inflation runs rampant, where currencies collapse overnight, where wealth can be confiscated with a pen stroke, Bitcoin isn't a speculative trade. It's survival. It's an insurance policy. And that insurance policy is spreading thanks to one simple factor: internet access. Anyone with a phone can participate. That universality is a game changer. Even in developed economies, cracks in the system are showing. Debt levels are unsustainable. Fiscal policies are stretched. Central banks are boxed in. And each time they try to tighten, they risk breaking something in the system. We saw it with regional banks. We saw it with the UK pension crisis. We'll see it again. Each break makes the case for Bitcoin stronger, not weaker. Now, zoom back to commodities for a moment, because oil and gold tell us something too. Oil's decline acts like a hidden stimulus, easing pressures across the board. That's bullish for growth and consumption. Gold's role as a safe haven continues, but even gold's scarcity doesn't compare to Bitcoin's mathematically fixed supply. Gold can still be mined, Bitcoin cannot. That difference matters, especially to institutions who model scarcity into their valuations. The US dollar, despite its short-term pullback, remains dominant, but history shows that strength can attract its own set of problems: export pressure, global liquidity strains, coordinated interventions. If deregulation and tax cuts boost capital returns here at home, demand for US assets rises, and with it, demand for the dollar. That dynamic reinforces the bullish backdrop for risk assets, denominated in dollars. It's a loop, and right now, it's pointing in one direction: higher. So we have the perfect alignment. Have institutions accumulating at scale, retail selling in fear, liquidity injections from the Fed on the horizon, scarcity-driven assets ready to explode, geopolitical instability pushing global demand into crypto, commodity trends acting as stealth support for growth. That's not hype, that's the setup. A setup that looks eerily similar to the moments right before major breakouts in the past. And if you think about it carefully, you'll see why this alignment is so rare. Normally, you don't get all of these factors lining up at once. Normally, you get fragmented signals, some bullish, some bearish. But right now, everything is converging, and the institutions know it. That's why they're not hesitating. That's why their streak of buying is intact. And that's why retail, once again, risks being left behind. The key to understanding this moment is realizing just how powerful liquidity cycles truly are. They are not random. They are not abstract. They are the heartbeat of financial markets. When liquidity expands, risk assets rise. When liquidity contracts, markets stumble. And right now, after the most aggressive contraction in decades, we are heading directly into a new phase of expansion. This isn't speculation, it's math. Every cut in interest rates, every injection of liquidity, every fiscal move designed to spur growth sends new money flooding into the system. That money doesn't just sit idle, it seeks returns. And the assets that provide the clearest path to asymmetric returns, crypto, scarce commodities, high growth equities, get the biggest lift. Retail, unfortunately, continues to miss this playbook. They see a headline about inflation cooling. They see a chart bouncing a few percentage points, and they rush to sell, thinking the move is already over. But institutions see the lagging effects. They know liquidity flows take months to fully hit markets. They know the biggest returns often come after retail has already given up. That's why they're buying now, while fear dominates, while uncertainty is high, while retail is cashing out. Think back to the last cycle in late 2018. Markets cratered, retail investors fled, institutions positioned quietly. By 2019, as the Fed pivoted, risk assets surged. Those who sold early missed the rebound. The same happened in 2020. Pandemic panic selling, institutions buying, trillions of liquidity injections, and one of the fastest rallies in history. The playbook doesn't change, only the players do. And in this cycle, the players are bigger, more coordinated, and more determined than ever before. We're talking about global asset managers with trillions under management, pension funds seeking long-term hedges, sovereign wealth funds diversifying out of fiat currencies. These are not small buyers. These are whales that can change the entire tide of markets with a single allocation shift. Now let's drill down on the psychological warfare that happens in these moments. Institutions thrive on volatility. They thrive on fear. They need retail to sell so that they can buy. They need weak hands to shake out so that they can build positions without pushing prices too high. Every headline of doom, every dip in the chart, every panic-driven sell-off, it's all part of the transfer of wealth from the impatient to the patient. And right now, that transfer is happening in real time. Retail selling, billions. Institutions buying, billions. The cycle is repeating, but this time, it's not just stocks. It's not just bonds. It's crypto too. That's the biggest difference, because crypto, unlike traditional assets, has absolute scarcity built in. Bitcoin's cap at 21 million means institutions can't just flood in whenever they want and expect unlimited supply. If they want exposure, they have to compete. They have to buy what's available. And when demand rises at scale while supply is fixed, the result is explosive upside. Ethereum's network effects only magnify this. Every application built, every layer 2 scaling solution launched, every new wave of adoption increases the gravitational pull of the Ethereum ecosystem. Institutions don't just see ETH as a token. They see it as equity-like exposure to a global, decentralized economy. That perspective changes how capital flows in. And then you have XRP, positioned in a unique lane: cross-spur, settlement, speed, liquidity provision, all directly tied to financial infrastructure. If adoption continues, XRP isn't just a speculative trade. It's a tool embedded in the global financial system. That kind of positioning is rare, and institutions understand it. Now add in the global backdrop. Inflation may be cooling in the US, but globally, instability is rampant. Currency devaluations, debt crisis, political shocks, they all push demand towards scarce, neutral assets. Bitcoin is neutral. Ethereum is neutral. XRP, depending on adoption, can play that role too. In emerging markets, this isn't a debate. It's reality. People are using Bitcoin today to protect their wealth from inflation, capital controls, and government overreach. That trend will only accelerate. The parallels to gold's adoption are striking. For centuries, gold was dismissed as a relic until monetary systems faltered. Then, suddenly, it became indispensable. Bitcoin is on that same trajectory, but moving faster, thanks to digital rails and global connectivity. And don't overlook the impact of technology itself. AI, automation, and robotics are reducing scarcity in labor and production. As the world shifts toward abundance in some areas, investors will pay a premium for the few things that remain scarce. Bitcoin's scarcity, Ethereum's network, XRP's utility, these are the assets positioned to absorb that premium. Meanwhile, commodities like oil are quietly reshaping the macro backdrop. With oil prices falling sharply, consumers and businesses are getting what amounts to a massive tax cut. Lower energy costs ripple across everything, from transportation to manufacturing, freeing up capital and easing pressure on inflation. That's fuel for growth, fuel for risk assets, fuel for exactly the kind of rally institutions are positioning for. And then there's the dollar. While it's seen short-term weakness on a long-term trade-weighted basis, it remains incredibly strong. If deregulation and tax cuts amplify US returns, demand for dollars rises further. Strong dollars pull global capital in. That capital has to go somewhere. And with US equities near highs and bonds less attractive, scarce assets like Bitcoin, Ethereum, and XRP become prime destinations. This alignment, liquidity injections, institutional adoption, scarcity dynamics, global instability, and commodity relief isn't just rare, it's historic. It's the kind of setup that only comes along once in a generation. And the institutions know it. That's why they're not hesitating. That's why they're buying when retail is selling. That's why they're preparing for a future most retail investors can't even see yet. The bottom line is simple. Cycles repeat. Liquidity drives markets. Scarcity wins, and institutions position early. If you're watching carefully, the signals are flashing bright green right now. And here's what I'll leave you with. If you want to actually take advantage of these cycles instead of being caught on the wrong side like most retail investors, you need to understand how to identify asymmetric opportunities before the crowd. That's exactly why I put together the Ultimate Millionaire Investor Guide, Find 100X Stocks. It's in the pinned comment below this video, packed with documents, images, videos, and more, designed to help you think like the institutions do. And one last bonus for those of you serious about positioning. You can also grab free NVDA stocks up to $200 from just a $1 deposit using my Robinhood link. Check the description for that. Stay sharp, stay informed, and I'll catch you in the next.